The S&P 500 has dropped 11.5% in just 1 week. I think it's time for a story. The Tale of Three Traders, a stock market story. "40 years ago, there lived three stock traders, Kevin, Joe, and Nick. One day our three fellows decided to make a bet amongst themselves. Hey guys, pause for a sec. I've been thinking lately. I know we all have different investing styles, with mine being the best obviously, but why don't we make things a little bit more interesting?"
What did you have in mind, Nick? I think my bad luck is finally starting to turn, so I could be up for it.
That's what I like to hear, bro. So we're all just starting our investing careers now, right? Well, why don't we have a competition to see who ends up with the most money at the end of our lives, and whoever wins gets the other two people's money.
All of the money? I don't know, man. That sounds like a lot.
Kev, quit being a little...
Guys, can you knock it off for a sec? Nick, your idea is stupid, just like your trading method. Why don't we just see who has the most money by retirement, and then that person has bragging rights?
Okay, Joe, Mr. Big Brain, but why are you always picking on me? Kevin's the one who sucks at trading.
Because you're always overconfident, man. But yeah, Kevin, stop being a little...
Alright, so at this stage in the story, the three brothers have decided to make a bet amongst themselves to see who is going to make the most money off of their investments by the time that they retire. Now the story goes on to give a few more details of their competition. Each brother was going to invest $200 per month over the next 40 years into an S&P 500 index fund. The difference between the brothers, though, would be that each one would have a different style of how they would try to time their investments into the market. One investor was the world's worst market timer. Another was the world's best market timer. And the third and final investor simply invested slowly and steadily. How did they all make out? Over this time period, the S&P 500 had experienced 4 major drops. 33% drop for Black Monday, a 20% drop for the Kuwait War, a 49% drop for the dot-com bubble, and a whopping 56% drop for the financial crisis that just occurred in 2008. Kevin, unfortunately, had a really rough go of it. He had the worst market timing possible. He ended up starting off by putting his $200 per month into a savings account that earned him 3% interest. Now, Kevin's plan was that he was going to keep this money in his savings account on the sidelines and wait for a good opportunity to invest it in the market. The problem was the good opportunity that he thought he had actually ended up being the very peak of the market in 1987, right before the drop of Black Monday. So he ended up losing 33% right off the bat. Chalking it up to bad luck, Kevin proceeded to do the exact same thing 3 more times. He would save his $200 per month in the savings account, wait for his opportunity in the market, but time and time again, he invested it right at the peak of the market before it went into its crash. In effect, he invested his money at the worst possible times that he could. This includes investing right before the financial crisis in 2007. And ever since that day, Kevin has still been putting that $200 per month into a savings account, waiting for his next opportunity to ride that investment into the depths of hell. So obviously, Kevin must have lost all of his money, right? He must be homeless by now. Actually, because Kevin never sold and he continued to invest his money, albeit at the worst possible times, he actually turned his $96,000 worth of savings into $663,000. Yeah, I know, right? This might be very surprising to you. He still had a very good return with the worst possible market timing that you could have. Let's look at Nick and Joe's results to see if we can understand what the heck's going on here a little bit better. Now, Nick had incredible luck. He's some kind of wizard with the power of clairvoyance. So Nick also saved his $200 per month in a savings account at 3% interest while he waited for his opportunity to buy into the market. But in his case, he actually bought at the best possible times. He bought at the very bottom of the crashes. Perfectly timed the market, so he was able to buy in at the cheapest possible price at the downturn of every crash. Now, obviously, this level of market timing is inhuman. It's just not possible to do in reality, but bear with it for the nature of the story. So, how did Nick do? Well, his $96,000 worth of savings became $956,000. He certainly did better than his brother Kevin, but is it that much better for being the best market timer in the world? Let's see how the final brother Joe did before we draw any conclusions. Now, Joe was different from his brothers. He wasn't interested in trying to time the market at all. Instead, all he did was simply set up an auto deposit into his investment account of $200 per month that would get automatically invested into an S&P 500 index fund, starting from day one and ending at the end of that 40-year period. Just $200 every month invested into the markets. No timing at all. This means he invested on the way up as well as on the way down. And he didn't pay attention to any stock market news. He didn't pay attention to if the market was crashing, if it was going way up. He just let his investments do their thing and just kept contributing to them. So how would you guess that Joe did? Now, intuitively, you might think that maybe he would do maybe middle of the road in between his two brothers, in between the worst market timer and the best market timer. But actually, Joe's $96,000 worth of savings became almost $1.4 million. Crazy, right? Joe's completely hands-off approach beat Nick's perfect market timing, and by a lot. But how the heck did this actually happen? How does this make any sense? Let's stack up all the numbers here again and take a look. So we have Kevin with the worst timing at $663,594, Nick with the best timing at $956,838, and Joe with just chillin' at $1.386 million. Dang, Nick didn't even become a millionaire after that perfect market timing. That must really sting. So here's why the investments worked out the way they did. It can really be summed up by the phrase, it's not about timing the market, it's about time in the market. Kevin and Nick both held their money in savings accounts for long periods of time while they waited for their opportunity to invest. This means that they weren't invested in the stock market for the entire period, and this is really important. Even though Nick timed the market perfectly, he still missed out on a ton of gains because he was not investing his money immediately into the market. He had his money on the sidelines for long periods of time, and Kevin was obviously hurt extra by this because he also had the worst market timing possible. But Joe simply left his money in the markets for the entire time, which meant he benefited from the compounding effect for that entire 40-year period. The reason why it's so important to stay invested in the market is because there may only be a few significant trading days for the entire year. There have been studies where they've looked at investors who have missed a portion of the best trading days over a specific period. And what they found is if you just missed those handful of days, you would have missed out on a huge amount of the gains. This is a topic that I'll cover more in another video because I think it really deserves its own dedicated video to really dive into the depths of it. But this is one of the main reasons why it's so important to stay invested in the markets if you're looking for a long-term return. By staying in the markets, you'll ensure that you're always along for the ride. And yes, yes, sometimes that ride does go down, but it also goes up, especially over long periods of time. It tends to trend upwards. And if you're trying to take your money in and out of the markets, you risk missing just those handful of days that you need to be invested for to really capture the gains that happen in entire years. So by staying in and staying consistent, the data is very clear on this. You will be way better off in the long term. Even if you could possibly have the best market timing in the world, you'll still beat that. The greatest part of this is that it's extremely easy to do. Anybody can take $200 per month, $100 per month, whatever amount you want to do and whatever schedule you want to put it in. Anybody can do that and just be completely hands off with it. It takes zero skill to do. I mean, a sleeping person could do, and they would get a better return over time than somebody who has perfect market timing. And the fact that this is the best way to invest for the long term is incredible, because it means that anyone has the ability to do it. And that's what I really want for you. That's why I'm sharing this with you today. I want you to be able to have that 1.3 million. So how can we apply this to what's currently going on in the stock market? Well, you see that there's a lot of fear in the media, there's a lot of fear in the people, and everyone's debating whether they should take their money out of the market or not, and then potentially try and buy in at a lower price. Well, after everything that we've went through today, you can see that it probably doesn't make sense to do that. If you're already contributing to your investments on a regular schedule, then just continue to do that, because the data is very clear that that's the best way to proceed forwards. Even if the market does crash from here, you're better off by staying consistent in your schedule. The people who are taking their money out of the markets and trying to buy in cheaper may feel that they've made the right decision if they do buy in cheaper, but in the long run, you're actually going to have a higher return, because the market can take a long time to recover. So while these people are on the sidelines, they're missing out on being invested in the market, and nobody knows when those days are going to happen that provide those returns that you really need to capture by staying invested. So I hope that this video helped open your mind to the idea of market timing versus time in the market, and I hope that it provided you some comfort and solace if you're already somebody who's investing on a regular schedule and has been a little bit shaken up by the fear of the global recession or the stock market correction or crash or all of the stuff that's going on right now. And with all that being said, this is probably going to be my last video for now on the topic of stock market corrections, crashes, recessions, that type of thing, and I'll get back to my regularly scheduled content of how to build your own portfolio with index funds. That's something that I'm going to be progressing towards soon. You can look forward to some videos leading up to that coming out in the very near future. So that's it for me today, guys. I'm Steve Antonioni, and this has been Cash College on timing the market versus time in the market. Thank you all for watching, and I will see you again soon.